Hi, I'm Magda Ramada from WTW, and this is the Future of Insurance Live from ITC Vegas.
Magda, it's fantastic to sit down with you. We try to do this beforehand, but even better to do it in person.
It's amazing. I'm so happy to be here.
Yeah, it's great to meet you in person.
Yeah.
Tell us a little bit really quickly about you and about your work at WTW in particular, and then I've got some questions for you.
Yeah, so I've been at WTW for 20 years almost, which is a lot, and I'm still loving it. And I sit within insurance consulting and technology. So WTW is a huge organization, 40,000 people, of which 1,500 are only dedicated to insurance clients.
Yeah.
And we have consultants and we have technology, and we develop solutions that combine consulting and technology. I sit within the technology team and I interact with external technology providers, and we all work together to shape our products so that they evolve quickly enough. And so I work with clients on the digitization, on the transformation, and I work with the technology team to make sure that input goes into our product design and roadmaps.
Okay, and we're at ITC and you work in ICT. Am I getting the letters?
Yes,
okay.
it's true.
If I mix it up. Given your purview, and you have a global role in that
Yes,
sense.
I have a global role, and then I'm not an actuary, so I became this jack of all trades to some extent. I started doing a lot in the pricing and underwriting area for personal lines and P&C, and then it evolved into but Magda could actually look at life. She could also look at commercial lines, and then it evolved in the value chain as well.
Yeah.
So yes, I'm global, and it's a lot of the value chain. No reserving though.
Okay, no, that's fair. So you use the word evolve. I want to ask about that. I've seen either an actual evolution of products or a very strong need to, yet lack of it. What are you seeing from a product evolution standpoint? And I would say not just the products, but maybe the need as well, and sort of our long-term relevancy as an industry even.
So I think, there's now there's more of a push towards product evolution. So insurance products used to be very monolithic in the way they were actually coded and put into the systems, and that restricted the way they could evolve very quickly. They also were not generating the data in the right places. So it was very difficult to adapt your product portfolio.
Yeah.
You used to have one product, and then you were testing in the market, and perhaps you had some product lining and some versions of a product, and then that proliferated into 60 versions of the same product that all looked like different products in your systems, and the data was generated in silos, in product silos, right? So now with new policy admin systems, that has changed, and we're being able to generate the data at different levels of a product, so that we can actually iterate it more quickly. You can do A/B testing. So I think that is changing. Is it changing for the whole market? Is every insurer doing it like that?
Yeah.
No, sadly not. A lot of them are still stuck with legacy systems that don't allow for that, and with policy admin systems that are very stale. So, but there is a transition, and I think a lot of insurers realize that actually working on the customer journey and on product design is as important when you want to convert a sale as is pricing, and that more dynamic products can actually also help you have a better underwriting footprint. Because you can cater to different segments and to different profiles of risk in a different way. So it's changing. We're not there yet at all.
Do you think it's changing differently in commercial lines than it is to personal lines?
Yes and no, because in personal lines, we are used to more commoditized products that are sold as they are in channels, right? So products they didn't used to be modularized, but then personal lines digitized and digitalized earlier. Yeah. And that enabled them to go for a more dynamic product approach and iterative product approach. So they have better tools and better data now that they had 10 years ago to actually go down the route of more dynamic products. Yeah. On the other hand, commercial lines always had dynamic products in a sense, right? Yeah. Because these are bespoke products and programs. And so the difference is that in the last 3 years, we have seen acceleration of digitization and data being generated at the right places, and a data insight augmented type of underwriting. But there's still a long way to go, right? Yeah. And so I feel products in commercial lines have been always dynamic, but they haven't been as data driven as they should be for that, to be more of a systematic kind of approach to dynamic products. And that's where we're getting now.
Interesting.
And then, an additional point is when you look at contracts in the commercial lines, perspective, they're very complex,
Yes.
right? And the modules are not as straightforward, meaning that you need to start generating data at a clause level, at a subclause level, and for dynamic products to really work, and you to be able to actually extract risks that you don't like anymore or price them at a more granular level, you need all of those components to generate data and to be linked to your loss experience. And so that you can have a look at accumulation at a more granular level, and that also feeds into your capital management, right? And so there is a process in the market, they really get it, but there is a long way to go in terms of the actual tech tools that will enable that type of approach to commercialize products.
It's fascinating to me. It almost sounds like the dynamicism that has historically been built into commercial lines and specialty lines by extension is almost standing in the way of a new generation of dynamicism, or making more complicated in a sense. Never really thought about that. That's
and there is a trade-off, right? I mean, you can go as complicated as you want, right? And then if you look at the billions of combinations that you'd have on attributes that you can test, and if they work and if they don't work and how they impact your risk, that generates a lot of complexity, and complexity actually has a cost. So you need to find the right trade-off between what are the attributes of a product that I really want to test, what are those that are really affecting my portfolio at a portfolio performance level. And all of that needs really the proper data and the proper approach to how you look at your portfolio from a more bespoke risk within a policy kind of way. And you need the right systems to do that, the right workbenches, the right data liberation approach. So it's a lot more complex. I mean, the idea we'll get, right? But then when you implement it, it takes some time to do it.
So being at ITC, and I'm looking at, without naming anyone, certain vendor like banners hanging from the ceiling. Do you think, as you talk about what's needed, do you think the tools exist and it's a question of whether we're actually implementing them all, or do you think they're not quite there, they're in their infancy? Like, where are we in delivering on what's actually needed here?
That's actually a very good question. I do think they exist. I mean, we as a technology provider will tell you, of course they exist, we're building them, right? But there's certain areas where we still need to push the boundaries, like computable contracts, for instance, like the ability for contracts to be fully digital and machine readable. So we have been working on algorithmic underwriting, right? And some of it is rule-based, some has, smarter algorithms behind it. But you need to actually be able to assess the different parts of a contract and the risk, and compute the risk in a way that you have an agreement with, the appetite of underwriters, so that you can place it through an algorithm and do digital trading, essentially. And so, yes, we are there yet. We're getting more digital. The technology to go from what we have today to a more digital approach to risk, and to articulate the appetite so that we can trade more digitally and in a more automated fashion, and assess those things and generate the data at the right places, is there. But is it there for every type of risk? No. Is it there for very complex policies that actually have taxonomies and hierarchies, and how all of those different parts of a risk and exclusions actually work together? Not really. And so we do have better tools to generate data and to aggregate data and to have an augmented underwriting approach, right? But the future of really a lot of that risk becoming more fungible with capital, and that risk becoming computable in a truly, machine readable, computable sense, we're far away from that. Why is it interesting? Because if you get there, then you actually can do things like securitized risk and, ILS on steroids, right? So really repackage things, deal with your exposure and your portfolio management in a different way, find alternative sources of capital for parts of your risk that are in your portfolio that now you have at a granular level, and you can extract or generate a different appetite or generate data to actually improve the price on that part, as opposed to having it in an exclusion. So it will be an evolution that actually allows us to increase appetite, I hope, and close the protection gap, because we will have more data insights at a more atomized level of risk. So that's why some people talk about computable contracts, which is kind of the nirvana, right? The North Star, where we would like to go, where a machine can read a contract and then extract information, match it to claims. Some people have been able to do that in very specific areas of risk. But you don't need to get there to reap a lot of the benefits. if you have digital contracts that are more atomized and that can react dynamically to underwriting decisions and portfolio performance, then you're almost there. So we say, we need DAT contracts more than computable ones. And it goes a long way. And I think it's more realistic to think that the market will go there than to really crack that full computability of a contract.
That's really interesting. I do want to press on, you use the word securitization.
Yes.
And one of the themes that came up in my interviews here last year was a beginning of the diminishing of the relevance or importance of insurance in at least certain buckets of large exposure, et cetera, where less and less of losses are insured losses. What's your sense of not just the long-term viability, like I don't think we're going to disappear, but the attractiveness of insurance as a vehicle to take on risk? When, you talk about all these changes that are needed, are we keeping up with them, and are others either coming in or potentially coming in? Where do you see that balance, and are there things the industry should be doing to move us forward?
I love that question. Thank you for that. I think, if you look at statistics, what you see is that relevance in terms of the amount of the protection gap and how much risk is actually going into the true or more incumbent insurance industry has been diminishing for the last decade. Right? So we could argue that we're becoming less relevant. I do think, though, that it would be unfair to truly say we're becoming less relevant. It's more that the amount of risks and the amount of new risks and risks that have changed in nature and in structure and the intercorrelation among those risks has accelerated a lot in the last 10 years. So yes, that has generated the need for more insurance that is not keeping up with the evolution of risk itself for new areas of risk. And that goes for transition risk, but it also goes to risks about intangible assets. There's a lot of evolution in the way risk have been behaving in the past 10 years that we haven't been able to keep up with. So are we becoming less relevant? Yeah, we kind of are. Are some large clients and companies going for self-insurance and captives and alternative capital? Yes, they are. Are they doing that for every type of risk? Not necessarily. So I think, starting with an approach where you say, well, let's develop a gap insurance. It's not going to be what's going to protect, I don't know, the formula of a very large beverage company, but it's going to, help insure certain intangibles. Well, we have done that. So it was like the product is very simple, but it will evolve very quickly. So we designed the evolution of that product in a way that it will incorporate data and evolve, and then it will be able to cover more the more data we generate on the process. So I do think that it matters that we have an approach to evolving products and make sure that we generate the right appetite for new types of risk by being very creative about the type of data that tells us, helps us in the risk assessment. When historical data is absent or obsolete because the risks change and the way they behave. But then the way in which we are able to then find the right capital for those products also matters, right? And capital will find its products. But how you build a product, how you securitize, how opaque a certain product is, actually matters. I mean, we've had a huge financial crisis because certain products were incredibly complicated and no one understood what was in there. So if we want to go towards more securitization, data and risk tokenization that can connect to capital in seamless ways and more algorithmic ways, that has to be on the basis that those products need to be incredibly transparent, right? And that begs the question, do we have enough standards on data? Do we all have a similar view on risk to actually do that? So it's more complex than it seems. But I don't think any capital will deliver the level of sustainability that we need as an industry, and is not comparable to reinsurance and insurance capital. So it might have the appetite, but then it might go away. It will depend a lot more on macroeconomic factors, right? And we as an industry have a mission to mutualize risk, to enable growth, to enable innovation, to be able to transfer and consume risk so that others can go and change the world. And that means that we need to deliver on appetite for new areas of growth that by definition will have no data. And yeah, that's my call for action is really there. It's not about, well, are we less relevant? Yeah, I mean, the statistics say so, but it's more about how do we close the gap before others do in a less sustainable way.
Yeah. I hear you. It's a denominator growth problem as much as it is a numerator question for us. I keep seeing all the stuff out here, which is it's not necessarily point specific, which InsurTech has been over the years.
Yes.
There are some bigger sort of ecosystem and large scale solutions out here. But the things that you're talking about are quite macro, quite like global insurance industry. Where are we heading? What matters? What do we need to think about? How do you, as you sit here at ITC, what is it that you're sort of metering out? Because it does feel more point specific, and your view is so much more global, at least the points you're talking about. So what is an event like this to you?
So I'm going to use a buzzword.
Okay.
Which it's becoming, everyone's talking about ecosystem and ecosystem articulation, but I guess that's what bridges those two things.
Yeah.
So we work with a lot of partners, and then what you do is, we have a Guidewire partnership, and it enables us to implement things very quickly, but it also enables us to have conversations about what type of data should this type of system be generating, right? So if you have that vision of where this future target operating model of the insurers should be going to, if you understand how technical functions should converge, what areas should be transversal in terms of modeling, in terms of data, the implication that has from a modeling governance perspective, for instance, then you're able to actually articulate an ecosystem in a way that it delivers the different milestones that you have to go to deliver on that macro view.
Yeah.
That's, kind of what I do and what I like to do, to be able, at WTW, we spent a year with our best experts articulating that view of what should an insurer look like if we build it from scratch. Yeah. What should insurers look like in 5 years? What does that mean in terms of how data has to be handled and models have to be handled and how our tools have to evolve?
Yeah.
And that makes it easier to connect that macro view or that view of a more holistic view of an insurer and of the industry to point solutions, as you call them. And then for us, it's also easier because we do have solutions across the value chain. So as long as we're building them in a way that accounts for that connectivity, we're better able to deliver certain things, right?
I was going to make that the last question, but you just said something that really struck me. If we were to build an insurer from scratch, and what does an insurer need to look like 5 years ago?
No, 5 years from now.
Oh, sorry, 5 years from now. I'm living in the past. Can you be that 5 year down the road insurer if you're not built from scratch?
You can. I mean, I don't know,
does it look the same?
Job. No, it's just like sometimes it feels like pulling teeth, but at the end of the day, there is a transition, and we always talk about, so when we did this, what is the future target operating model of an insurer? We look at all of these different boxes as in, okay, well, this is your reserving function, your new capital function, and this is how it works for a P&C insurer and for a life insurer. And then essentially we said, well, do you need to actually make everything sophisticated? Not really, right? Certain markets don't need sophistication or call all of your boxes in your target operating model. But the way in which you actually evolve some of them will impact your ability to evolve the other ones later on. So you have to have that view, right? So I think that's the answer. The answer is you can evolve and you can become as nimble as a insurer from scratch. And some insurers from scratch have actually failed at deploying the right technology stack and being as agile as they wanted to be. So I think that you build differently if you're building from scratch, but the transition is certainly possible and necessary.
Well, I love that. You're not precluded from anything, whether you're a startup or a legacy player.
Not at all.
I say all the time, but I'm curious about what does it take to be an insurer from 5 years ago. I've set up a totally different kind of podcast. I can't thank you enough for being here and for giving me some time. It's super fascinating. And you are pushing on things that I think we should be contemplating more, and we get very caught up in the day-to-day or the immediate issues that we're facing. But if we don't step back to think about some of these bigger issues, and for big commercial lines, right, are we moving in the right direction for where this ultimately needs to go and the flexibility we need? We'll wake up at some point and be like, it's too late. We should have move these
It's never
pieces.
too late, Brian.
It's never too late. That's a fair point.
But yeah, but you might miss the boat on some lines of business or some types of risk.
Yeah.
Or
it's harder if you started late when you could have if you accepted. Yeah.
But sometimes it's also easier because you know exactly what mistakes other did before you. I think that's an issue.
Yeah.
That's an issue in our industry, though, right?
Yeah.
It's like, okay, let's wait for someone else to do it first and see how it goes.
Yeah.
Do we have the data and how is this impacting ratios, right? And we kind of wait to have everything measured before we go for it. I think that's something we should change, but everyone can actually become a front runner, and it just needs the right strategy, the right approach, and a clear vision of where you're going.
Yes.
And dealing with territories and silos, which have always been an issue and still are an issue.
Yeah, fantastic. Thank you so much.
My pleasure. This is amazing. Thank you.
Thank you.